With a bit of a cautious view on the market. Gautam Duggad is head of research at Motilal Oswal. He is now joining us from the sideline of that conference. It's supposedly one of the big conferences happening now. Huge participation, like we had discussed with Gautam. Gautam, hi, good afternoon. So how have the first couple of days been and what's the feedback on India? Because nothing is stopping Indian market. It's clear. I mean, the market almost has no fear of what the Fed might do.
Hi, Anuj. Good afternoon. The context in which this conference is happening, obviously, we all know India has outperformed significantly despite so many headwinds thrown at this market. In fact, the theme of our conference, the Diamond Decade, is very amply reflected in the presentations that various CEOs have made. We have 15 CEO tracks. 12th one is ongoing. We have 3 more. But the mood is quite jubilant in that sense. And it is also a reflection of how India has done and what is happening globally in different geographies which are facing different troubles on multiple fronts. And that makes India stand very interestingly because our earnings have been so far very resilient, and we have seen a deluge of retail money which has come in and which has counterbalanced the big FII selling that we have seen from October to June. So yes, the mood is quite buoyant, whether it is on consumption, whether it is on financials, and across sectors, whoever has spoken. I also sense a bit of a left-out feeling in a lot of the clients whom we have interacted with over the last 2 days, and this conference obviously has 2 more days to go. So far, so good.
Left out, but we'll get back in, Gautam? That kind of feeling, or left out, now we'll stay out?
Yeah, Prashant, I mean, see, we cannot say anything with certainty in this kind of an environment because, as we have seen throughout 2022, things kept changing every 30 days. In January, we didn't know that by May we will be down by 15%. And similarly, in May, when everything looked quite dire, we have recovered almost the entire losses. And FII selling, which has been the talking point for the first half of 2022, suddenly became a FII buying figure of $7 billion almost in August. But one thing remains certain, Prashant, the feedback that we are having from the corporates across different sectors. We had 60 corporates yesterday. We have about 55 today. The demand environment seems to be extremely strong. And this is the commentary which is coming out across variety of sectors, whether it is a discretionary consumption basket, whether it is financials or auto for that matter. And after a long time, we are also seeing some sort of a commentary which is coming on capex and manufacturing, given the thrust that the government has put on it, whether through export or whether through PLI. But yeah, I mean, this is something which was missing till about 2018, 2020. So yes, whether that money which has gone out comes back or not, time will tell us. But at the moment, it looks like the way macro and micro are poised for India, and with crude having come down $20–25, God willing, if it goes down by another $15–20, you might see a very different sentiment once again.
Hi Gautam, good to hear that you're saying corporate mood as well as upbeat, and that too across sectors. Since we have been chatting many times about the nifty earnings growth from here on, we had a market expert who joined us earlier today and said maybe the street is being conservative and maybe the second half of this year on the earnings front could surprise positively. Do you think that could happen? Till maybe a month or so ago, we were talking about maybe there could be a downside risk to that 960, 970 rupees EPS target.
So Nigel, we are right now around 1,000 rupees for FY24 and close to 845 rupees for FY23, which basically translates into a growth of 16–17% for FY23 versus the delivered number of 735, 740 in FY22. What can surprise on the upside in the second half of FY23 if you see a further down leg on the commodity prices, primarily crude, and then of course the offshoots of various crude derivatives. If that were to pan out, we might see some sort of a margin upside versus what currently analysts are building in. Demand surprise might be there, but it is not going to substantially change the needle on the earnings. What we need support more on is on the commodity basket, because if, for example, if you were to assume crude at $75–80, then clearly a lot of the sectors will benefit on the margin front, especially B2C sectors. And then a more important point statistically, while our expectations for full year is about 15-16% earnings growth, the first quarter itself was 23%. So run rate expectation for the rest 3 quarters on an average is about 12-13%. So there is a room for market to surprise on the earnings, and given the kind of demand environment that we are seeing now around the festive season, and the fact remains that we are seeing this normalized festive season after 2 years of disruption, you might end up seeing some upside on the earnings. But even if this 1,000 rupees of earnings is delivered without any positive surprise, we might still be talking about some upside room from a point of view of next 12 months. It may not happen in the next 3 months, next 6 months, but yes, if this 1,000 rupees EPS gets delivered in FY24 for Nifty, you clearly have a room for upside even from these levels.
Okay, fair enough. Now, just discussing some stocks, and new themes are emerging, Gautam. I believe you wrote a big report on the footwear space, I think a couple of days back. Is that a space which is generating a lot of interest?
Indeed, in fact, as we speak, there is a CEO track of Metro, which is going on in the ballroom. What we are excited about is the room for growth which is available for the organized footwear space. And this is not a 1 year or a 2 year story. This is a next 3-5 year story. Secondly, aspiration levels are quite high, and the Trend CEO during the CEO track today reflected well on it, that if you compare the consumption environment today in India versus 5 or 10 years back and not too far back, you would see that one defining change that we are seeing is the level of aspirations across cohorts of age and cohorts of income levels. And that is what is fueling the lifestyle as well as discretionary consumption environment in India. So be it jewelry, be it adhesives, be it paints, building materials, footwear, apparel, you are going to see multiple years of growth in a lot of these spaces. However, one thing I want to caution is that some of these stocks have seen a very significant up move already. So somebody who has a very short-term view may not find the space very attractive. But somebody who has a 3 to 5 year view, I think there is enough room for compounding in some of these stocks. And footwear obviously is one of that sub-themes on lifestyle consumption, where we have initiated coverage on Metro and Campus with a buy rating.
When you say 3 to 5 year view, you mean that you should be ready to own them for those many years, right? Because that's what you mean, right, Gautam? If you're buying them now after the run-up.
Yeah, of course.
Is there? Do you sense a general lack of? You mentioned that left out feeling, general lack of paucity of not compelling ideas, but because of just the value of these footwear stocks, right? I mean, by your own estimates, they are all now, many of them are between 40 and 50, 55 times earnings, so they're not cheap. And is that a common theme across the board? And how are investors dealing with that? Are they going down the market cap curve? So what's the solution to that? The shortage of ideas in that sense. Yeah.
So Prashant, valuation has very rarely been a comforting factor in India if you talk about consumption stocks in particular. So anybody who has to look at a high quality consumption idea in India, whether from a 1 year perspective or a 3 years perspective, valuations are obviously going to present a challenge. And therefore, I take a lot of support from the history. If you had spoken about Titan 10 years back when the price was 300, even then the stock was an expensive stock on a 1 year forward PE basis. But here and now, 10 years later, the same stock is trading 9x higher and it's still an expensive stock. You can go on and on about some of the stocks, whether it's Pidilite or Asian Paint or Astral. There are a variety of stocks which have been forever expensive. And I mean, it's for an investor to judge what is his comfort on risk reward. But consumption as a space in India has a lot of legroom, because we are still talking about a $2,200 per capita income. And if all of us believe that India as an economy is going to transition from a 3 trillion to 5 trillion in a fullness of time, then clearly a lot of these stocks will have enough room. The important thing, however, is what is your time horizon. Coming to your second point on valuation, not just on consumption sector, but even on an India basis, let me take you back 10 years. So if you look at the last 10 years of performance, MSCI emerging market has been flattish, a 0.9% CAGR, whereas MSCI India, which has been an expensive market to begin with, has given about 12% compounding return. So what it has done is the valuation premium that India has versus emerging market has expanded from 50-55% to around 112%. And I think given the kind of opportunity that India offers in a world which is plagued by so much of geopolitical headwinds, valuations are not going to come down in a hurry is my view. And therefore the investors may have to stretch their time horizon if they still want to compound money from where they are. Otherwise, of course, you know, sometimes markets will go up, sometimes the markets will go down.
Gautam, what about IT? You know, the problem with the Nifty right now is what's preventing us from hitting those fresh all-time highs is that 16 to 18% of the index is struggling. That's the IT index. The index itself is 20% lower than what it was at the start of this year. What's the feedback you're getting on IT? Is there still investor interest? And also your view on the sector from here on. More pain ahead, or do you believe we're coming to that level where it's giving a bit of a re-entry opportunity?
So we've been positive, Nigel, on IT for last 3 years. Of course, it remains a fact that this year it has not worked. 2020 and 2021, it has outperformed significantly. Where are we driving comfort in IT is purely the quality and quantity of the free cash flows and the returns that they provide to investors through dividends and buybacks. So I don't know if I had mentioned this point in our earlier interaction, but if you look at the profitability of top 5 IT companies between 2015 to 2022 and add it up, it comes to about 5 trillion rupees, out of which they have returned to shareholders 3.8 trillion through buyback and dividends. So that's a cumulative 78% payout ratio for top 5 IT companies put together over 2015 to 2022. In the history of Indian capital markets, there is no such parallel in terms of both percentage and absolute amount of capital which has been returned. The problem with IT sector, however, is it's a global sector and therefore always vulnerable to what is happening in the near term in the global economy. And there we all know there is a problem on the big markets like US, where talks about slowdown, recession, Fed rate hikes are obviously mudding the field for the IT in the near term. So we are keeping the faith. We have about 200 basis points of an overweight, but our entire overweight and entire allocation in IT is towards large cap. We have zero allocation towards mid cap IT because there the valuations clearly are at a multi-year premium, and we have seen in the last 15 years, every 3 years, mid cap IT goes into a premium and a discount. Whereas investor interest right now, as one would imagine, has moved away a little bit from IT towards banking, because banking has come back into the reckoning after 2 to 3 years of underperformance, and which is also amply reflected in the relative outperformance of banking index by almost 38% YTD in CY22 versus IT index.
Okay, Gautam, I know you have to rush for your conference, but just one point I wanted to understand from you on cement, because right now the market just wants to sort of make assumption on what is the next company on the block. Almost every sector, every stock is being bid up. Your view here?
So, Anuj, I have two different views. On business, we are quite positive. From a near-term stock price movement and valuations, we are no longer comfortable now because we have seen a huge run-up in some of these names. In fact, you know, some stocks are trading at $300, $350 per ton on EV basis, and EV EBITDA 32, 33 times. So clearly, this sector is going to see a lot of action because of the corporate actions that we have witnessed in the last 2-3 months. Capacities will go up. Consolidation will be the name of the game. And we in fact have published a report, quite a detailed report on consolidation theme in cement just day before yesterday. So yes, we do expect a lot of action there. Maybe stock returns may not necessarily be commensurate with the news flow and action from here on, is what I believe.
Okay, all right, Gautam, thanks so much for joining in. Wishing you a good conference and appreciate you joining in